The birth of Wall Street. Before Wall Street became the epicenter of the global economy, it was just an ordinary street in a small colonial settlement. In the 17th century, this place was called New Amsterdam, and there stood a wooden wall built by the Dutch to protect against attacks. That very wall gave its name to what would become Wall Street. Over time, the settlement transformed into a trading hub of the British colony. Merchants, brokers, and sailors gathered here, closing deals right on the streets. And in 1792, an event took place that marked the beginning of the history of the American stock market. 24 brokers signed the so-called Buttonwood Agreement. This pact, under a buttonwood tree, became the foundation of the New York Stock Exchange. The birth of the New York Stock Exchange. After signing the Buttonwood Agreement, brokers began holding regular trading sessions, but they still lacked rules and structure. In 1817, they created a formal organization, the New York Stock Exchange. This was the first step toward building an orderly, regulated financial market in the United States. In the first half of the 19th century, the U.S. grew rapidly. Railroads emerged, large industrial companies appeared, and with them, new securities. Wall Street was transforming from a small street into a dynamic center for trading stocks and bonds. It was here that the industry began, which over time would become the heart of American capitalism. The era of the telegraph and explosive growth of financial markets. The second half of the 19th century became a turning point for Wall Street. The invention of the telegraph made it possible for the first time to transmit stock prices to other cities in mere seconds. And in 1867, Thomas Edison introduced the stock ticker, a device that printed quotes in real time on a long paper tape. This was a true revolution. The speed of information became a new weapon. The United States was rapidly industrializing. Steel, oil, railroads, all of it required capital. Wall Street grew alongside the economy, turning into the financial center of the entire country. By the end of the century, the street was literally buzzing with life. Thousands of traders, the first investment banks, and the bubbling energy of a new industrial America. The birth of financial dynasties and the era of banking giants. At the beginning of the 20th century, Wall Street became the arena where new financial dynasties were formed. The central figure of this period was John Pierpont Morgan, a man called the banker who could stop a panic with his mere presence. Banks were growing, the first major investment houses were created, and the financial elite became more influential than politicians. During this time, Wall Street was transforming, not just into a place for trading stocks, but into a center of decision-making that shaped the future of the entire U.S. economy. Financial clans like the Morgans, the Rockefellers, and other bankers began building the system of capitalism that would determine America's fate for decades to come. The crash of 1929 and the Great Depression. After the Roaring '20s, when America lived in a spirit of optimism and easy money, Wall Street was confidently heading toward the biggest crash in its history. In October 1929, on the day that went down in history as Black Tuesday, the market collapsed. Stock prices plummeted instantly. Investors lost entire fortunes, and panicked crowds filled the streets of Wall Street. The consequences were catastrophic. Millions of people lost their jobs, factories shut down, and lines for free food stretched for blocks. The 1929 crash marked the beginning of the Great Depression, the most severe economic period in U.S. history. It was then that the world realized just how dangerous an unregulated financial system could be. Economic recovery and the New Deal reforms. After the Great Depression, America faced the urgent need for a complete economic recovery. President Franklin Roosevelt launched the New Deal program, which included massive government projects, job creation, and infrastructure development across the country. At the same time, strict regulations began to be introduced on Wall Street. In 1934, the Securities and Exchange Commission, SEC, was established to prevent future financial disasters and protect investors. These measures helped stabilize the market and restore confidence in the American economy. Wall Street once again became a center of capital, but now under government oversight, laying the foundation for post-war growth, post-war boom, and the birth of consumer America. After the end of World War II, America entered one of the most stable and prosperous periods in its history. Returning soldiers fueled a surge in consumption and demand for housing, sparking a true economic boom. In the 1950s, the American middle class took shape. Families bought cars, televisions, and household appliances. Suburban neighborhoods emerged, symbols of the new American dream. Wall Street experienced rapid growth during this era. The economy was stable, the market was regulated, and investors confidently poured in capital. This decade became the foundation for modern consumer society in the United States. Crises, inflation, and loss of confidence in the markets. In the 1970s, Wall Street faced a new kind of crisis. The OPEC oil embargo triggered a sharp rise in energy prices, leading to runaway inflation. The U.S. economy entered an era of stagflation. Growth slowed while prices kept rising. Markets lost trust, investors pulled out, and Wall Street endured one of the most unstable periods in its history. A turning point came with the appointment of Paul Volcker as chairman of the Federal Reserve. His tough policy of high interest rates halted inflation, but at the cost of a deep recession. These decisions forever changed the role of the Fed and demonstrated just how powerfully monetary policy can impact financial markets. The digital revolution and financial bubbles. In the 1990s, Wall Street entered the digital age. Computers, electronic trading systems, and instant transactions completely transformed the speed and scale of financial markets. The end of the decade was marked by the dot-com bubble. Investors poured money into internet companies, many of which had no real profits. When the bubble burst in 2000, the market faced another sharp decline. Yet the lessons of the past were forgotten all too quickly. By the mid-2000s, Wall Street was caught in a new bubble, this time in housing. Complex financial instruments masked real risks, creating an illusion of stability before the next crash. The 2008 crisis and Wall Street today. In 2008, Wall Street once again found itself at the center of a global crisis. The collapse of the mortgage market led to the bankruptcy of major banks and triggered a chain reaction around the world. Millions of people lost jobs and homes, and trust in the financial system was severely shaken. In response, the public took to the streets, accusing Wall Street of greed and irresponsibility. Today, Wall Street looks different. Algorithms, artificial intelligence, and global markets have made finance faster and more complex than ever before, but its essence remains the same. Wall Street is a mirror of the American economy. Its ups and downs reflect the decisions of people, technologies, and risks that time and again shape the future of the entire world.